from Massachusetts, the ranking member on the House Financial Services Committee, and of course the co-author of the Dodd-Frank Wall Street Reform and Consumer Protection Act. He is with us from Capitol Hill. Congressman, good morning to you.
Good morning.
Congressman, I presume you've seen the news about Knight Capital. This, of course, is the market-making firm that suffered a software breakdown, the latest in a series of technological debacles in U.S. financial markets. I'll just cover it quickly. The flash crash, of course, Bats, the Facebook IPO. Then there's the collapse of MF Global, the fraud at Peregrine, and now this. Congressman, should foreign investors, should domestic investors, in your mind, still have confidence in light of all that in U.S. financial markets?
Oh, absolutely. On the whole, they work very well, and America continues to be one of the safest places in the world to put your money, partly because of the stability of our political system and the great wealth that continues to exist in the country. I did not yet see the story about Knight. One of the things we need to do, and one of the things that disappoints me about my Republican colleagues, is they have refused to provide the funding for the regulators that we need to deal with this. Technology advances, things get more complex, and they have refused, once the Republicans took over the House, to provide either the Commodities Futures Trading Commission or the Securities and Exchange Commission the funds they need. They've got to hire very smart people. They've got to have first-rate information technology. I also believe that, and this is also shown by LIBOR, but it's shown by Peregrine and some others, this notion of self-regulatory organizations is not something that we can rely on. Yes, the market should be making its own decisions through market principles, but that needs a framework of strong and well-funded regulators, and unfortunately, because of a political decision by my Republican colleagues, those funds haven't been available. And we're not talking huge amounts of money compared to what is wasted, frankly, in a whole range of other places like this infrastructure boondoggle in Afghanistan. We're talking about fairly small amounts of money in the federal budget term, and that's part of the problem.
Congressman Frank, even if you were to get the funding, do you believe Dodd-Frank and the Volcker Rule have been written in a way that if and when implemented, they would prevent situations like the J.P. Morgan CIO loss, as Eric mentioned, the Facebook debacle, the Bat situation, and now Knight Capital? Has Dodd-Frank been written in a way that when and if implemented, we wouldn't face these scandals?
Yes and no. We can't write a law that prevents technical errors by people. That's what you need, why you need the fund events. As far as J.P. Morgan Chase, yes. One of the biggest things we did was to regulate derivatives, which had sadly been allowed to grow as a very complex, very highly leveraged activity with virtually no regulation. And under the law, derivatives will now be regulated. If the law had been fully implemented, but part of the problem is, for historical reasons, cultural reasons, the Midwest versus the coast, our derivative regulation is split between two agencies, Commodities Futures Trading Commission, Securities and Exchange Commission. I would dearly love to merge them. It becomes politically impossible because it's the farmers versus Wall Street versus the Chicago Mercantile Exchange. But they finally got together. There were 10 commissioners. We finally got the basis for derivative regulation. Had that been in effect, and this isn't a question, by the way, just of Volcker, whether it's done in the bank or not. Derivatives have been done in secret, without adequate capital. Now that these derivative rules are about to be in effect, yeah, it is much less likely that a J.P. Morgan Chase would lose that much money without realizing what they were losing, and it would certainly be the case that whoever might be doing that would be adequately capitalized. Now, one of the things that we're fighting is a Republican bill that would say that none of the rules we are promulgating regarding derivatives would apply to an American institution that's doing it through a subsidiary in a foreign country. That's clearly a mistake.
Congressman Frank, on that subject, there's so much talk about bringing Glass-Steagall back. Would that be counterproductive for what Dodd-Frank is trying to do? And if we did, would that give European banks the opportunity to simply crush U.S. banks?
Well, the first thing to be noted about Glass-Steagall is that it wouldn't have had any effect on what I've just been talking about. And that's why I stress the Volcker Rule accomplishes a lot of what Glass-Steagall did. People should remember Glass-Steagall is 80 years old, or was 80 years old. It was 70 years old when it was repealed. And I voted against repealing it, not because I didn't think it had to be updated. We didn't replace it with something. But if you had just put back Glass-Steagall, you would have done nothing about derivatives, which were a major cause of the problem. You would have done nothing about lending practices. Look, one of the problems that Glass-Steagall didn't know about, that's a fairly recent one, is this notion of people making loans and then securitizing 100% of the loans, so they've gotten rid of all of the risk. So they make lending decisions as if there was no risk, when in fact there is. So, no, Glass-Steagall would not have been relevant to any of the things that we've just been talking about. And to the extent that we are concerned about the deposit fund being put in risk, a tough Volcker rule will do it, and I believe you're going to see a tough Volcker rule now.
Congressman, one of the things that neither Glass-Steagall nor the Dodd-Frank Financial Reform Act deals with is shadow banking. How much of a threat is shadow banking? What would you want to do about it if you were remaining in Congress, if you weren't retiring and not seeking re-election?
I would differ with you. Glass-Steagall certainly didn't do it yet. People should understand. What Glass-Steagall said was banks can only do this, but it left everything not in a bank totally unregulated. And so I agree with that. But our legislation does give the regulators the power to deal with the shadow banks. For example, the Consumer Financial Protection Bureau is given for the first time authority over payday lenders, check cashers, other people who've operated outside the banking system. And frankly, I think that's good for the banks, the small banks, because it reins in some of the irresponsible competitors. But what we do in this bill is regulate activity, not institutions. So if it is a financial activity of the shadow banking sort, then the regulators have the ability to go after it, and in fact, they are doing it. Some of these things, derivatives, have been done outside of banks in a kind of a shadow system.
So, Congressman, do you then support the restrictions that SEC Chairman Mary Shapiro wants to place on money market funds?
Some of them, not others. I don't think we should restrict, and this has been one of the things she talked about, the right of people to withdraw. I think if you start putting restrictions on the withdrawal, that would be a problem. But making them keep enough capital, yes, I very much think that's a very important thing that they should be doing. The fluctuation within a very small range, less important. So I support some of what she's proposed, but not others. But you make my point about the bill. The bill clearly gives you the authority to do it. There's a debate about whether or not what she's proposing is prudent.
Congressman
but there is no debate about having the right to do it under the law.
If I may, I know you blame Republicans for not giving the appropriate funding to implement Dodd-Frank here, but we just saw Jamie Dimon testify before Congress and Senate, and it just seemed across the board to be softball city. Do you believe that Washington and the regulators have the expertise and the ability to actually write and implement rules that are going to prevent losses like the J.P. Morgan CIO situation? Because it sure seemed like Jamie Dimon was untouchable when he testified.
Oh, I'm sorry, but I think you watched only the Senate. That is not true of the House hearing. And if you go back and look at the House hearing, if you look at the media coverage of the House hearing, there was a great contrast. Mr. Dimon was...
In fact,
I'm sorry, may I finish? May I finish?
I did watch both, but what is the big takeaway from Jamie Dimon testifying, and what changes are going to be implemented?
Sorry. Okay, no, that's not the original point you made, and I would like to be able to respond to your original point,
Please.
which I believe is inaccurate. In fact, the House members, particularly the Democrats, but a couple of the Republicans, were quite critical of the practices of the bank, asked some very tough questions of Mr. Dimon about his support for being totally deregulated in London. I asked him whether, when he talked about cutting back compensation, his own should be involved. He was unhappy about that. So, no, I reject the notion that we were safe about that. The takeaway from his is several things that we are pushing for. First of all, as I said, the Republicans put a bill through the committee I'm on, which would deregulate the activities of the branches of American banks in England and elsewhere. We fought that bill, and I think, frankly, the fiasco with J.P. Morgan Chase over there, under-regulated by the British authorities, as they sort of acknowledge, that we've killed that bill. So, one, you get tough regulation of American institutions, even if it's overseas. Secondly, we made the case for better funding for these entities. And finally, it's an argument for a strong Volcker rule, because if the Volcker rule were put in as it should be, J.P. Morgan Chase wouldn't be doing it. And again, as I said, the reception of Mr. Dimon, he was unhappy, and there was no softballing when he testified before the House.
Well, he seems somewhat happy now because his job seems to be quite secure, while other management at J.P. Morgan isn't. But back to Dodd-Frank.
Excuse me. No, I'm sorry. I don't like you to make these kind of comments and not let me respond.
Please, excuse me.
I particularly asked him. members of Congress cannot fire CEOs of financial institutions, and I'm sure you agree that wouldn't be a good idea. But we made it very clear, I made it clear, that for Mr. Diamond to blame others and not think about himself was a mistake. And one of the specific questions I asked him that made him unhappy was when he talked about cutting back compensation, was his own compensation going to be involved? So no, we were not in favor of exempting him. But it is not the case that we have the ability, nor should we, to fire CEOs.
Congressman, though, shouldn't the hearing have focused more on what happened inside J.P. Morgan and how it could be prevented in the future by the institutions themselves, whether it's J.P. Morgan or Bank of America or Citigroup or a European institution or an Asian institution for that matter? I recall very distinctly, and I did watch that hearing, that just about half of your questioning had to do with whether or not the regulatory agencies were being adequately funded, the very first point that you made in this interview right here.
Yes, but we also talked about the importance of regulation in general. No, I disagree that it is the function of the Congress to talk about how the bank should run itself. Our job is to have in place public policy entities, regulations that deal with that and set the rules. And there are several that I've specifically mentioned. One is whether or not the regulations that we're now getting about derivatives should apply extraterritorially when it's an American bank and it's an American branch. And yeah, we talked a lot about that. No, we were not, it's not our job, I believe, to try to deal with the internal management practices of the institution. We do want to have regulators who set the rules. For example, that there has to be margin, that there has to be transparency. One of the things that's clear about J.P. Morgan Chase, and it was true about AIG, they didn't know what their losses were. If the rules that we talked about had been in place, and they will be very shortly, then they would not have been surprised by losses that were first a 10% in teapot, and then $2 billion, and then $5 and $6 billion. That's our job. Our job is to put rules in place that govern, in general, the way things work.
The regulators were in the building. Do you believe they have the expertise to understand this financial engineering that firms like J.P. Morgan are engaging in? When you look at the way high flyers...
I'm sorry. Wait, may I answer your question?
Please.
The answer is partly no, because they have underfunded them. You can't hire people off the street and send them in to regulate these things. That's one of the reasons why I want those entities that have derivative regulation. Now, part of the problem was the regulators you're talking about were from the Office of the Control of the Currency, bank regulators, not people specializing in derivatives. One of the things we did in the bill was to say derivatives will be much more carefully regulated no matter who does them. It goes back to this question of shadow banking. We want much tougher regulation of derivatives, which we are now about to get. And yeah, you want to hire people who are able to do this. So secondly, though, what we are talking about is having rules in place so that when they engage in these kind of derivatives, when they sell or buy credit default swaps, they know what they're doing. They know what the prices are. And again, AIG had no idea how much they were indebted. And it turned out neither did J.P. Morgan Chase, that the internals in the bank weren't there because derivative trading had been so opaque. And our rules make it clearer.
Congressman, I'm sorry to interrupt, but we are running up against a hard commercial break. We must take it. May I ask you, please, to stay with us through the break and come back afterward?
How long is the break? 2
minutes.
All right.
Thank you very much. Congressman Barney Frank will be with us in 2 minutes for more. Stay tuned. Forgiveness by Fannie Mae and Freddie Mac, a very important decision rendered by the FHFA earlier this week.
I'm very critical of Mr. DeMarco's refusal to do it because he left out a very important thing, namely the foreclosure crisis. The mortgage situation is a major problem in the larger economy. It was interesting. Mr. DeMarco seemed to be acknowledging that Fannie Mae and Freddie Mac might benefit, but he was worried about what he said would be the effect on the taxpayer. But one of the things that's negatively affecting the taxpayer now is the slowdown in growth. We're still growing. We're doing very well compared to the developed nations of Europe, but not according to what we would like us to be. And I think getting some principal forgiveness would be a very important step in helping deal with the economic sluggishness we have. And his refusal to do that is disappointing. Look, Mr. DeMarco is a holdover. President Obama tried to replace him with a very good guy, a bipartisan former bank commissioner, at the time was a bank commissioner of North Carolina, and the Senate Republicans just blocked it.
And Congressman, though,
Mr.
DeMarco said in his analysis, in the FHFA's analysis, it would be a bad deal for taxpayers, maybe a good deal for those people who need forgiveness, but taxpayers overall would not benefit.
But I think he's wrong about this because, first of all, I believe he greatly exaggerates the extent to which this would lead other people to default. It turns out people like their homes and aren't ready to try and default and take that risk. But secondly, and I meant to address that, he says it would be okay for Fannie Mae and Freddie Mac, bad for the taxpayers. But what's worse for the taxpayers is this slow growth. That hurts the taxpayers in many ways. And I think if he was going to look beyond the specifics of the institutions he runs and into broader issues, it's a mistake to look only in the short term at the taxpayer outlay without looking at the effect on the broader economy. Because stimulating economic growth beyond the relatively sluggish pace we now have would be good for the taxpayers. So I believe that it is in the taxpayers' interest for us to be able to stimulate growth. And this was a major thing that could have helped with growth.
Congressman, we thank you for staying with us. Thank you for the extra time. Congressman Barney Frank, the Democrat from Massachusetts, with us from Capitol Hill here on Market Makers.